Welcome back. In this section, we're going to talk about how you start your business and what things you need to be keeping in mind from a legal perspective as you make that big step. We're going to initially begin at the beginning and provide a reminder to you that the basics really matter. And you might be questioning why in a legal environments course you're getting things like business planning. And I'm going to touch on it here, and we're not going to get into business planning. There's plenty of other courses and plenty of other resources for that. But I want to help you understand why business planning is critically important before you get started. And so going into your business, your new business venture, you need to have a business plan put together. And that business plan is going to help you with financing, but it's also going to help you identify the issues that might be necessary for you to consider when you are looking at the legal environment in which you're going to be participating. And so that business plan should include a SWOT analysis: strengths, weaknesses, opportunities, and threats. And there's a lot of resources online on SWOT analysis. You should do market research. And this is for two reasons. One, to understand who your target market is from a standpoint of marketing, sales, and product design, but also understand where you're going to be conducting business, because that's going to impact potentially where you have to legally register your business, where you have to be licensed, and what type of entity you'd be choosing to conduct your business with. And the third piece is the financial plan. And again, the financial plan is critically important because if your business is going to require funding, that's going to impact the legal environment. Loans are going to have one type of structure and implication. Your own savings may have another, and there's ways to structure that, and we'll discuss that briefly here. There's ways to structure that to protect you and your assets. And then you may be looking at potentially investors down the road, outside investors, passive investors. And thinking about those things at the beginning makes it that much easier and cheaper when you build your business to factor in the legal components. Again, as you guys probably are all aware, lawyers cost a lot of money. And so to the extent that you can think about these things ahead of time and set yourself up for success, it's going to save you a ton of money down the road and a ton of trouble as well. So start with the basics and put your business plan together. Make sure you've got your SWOT analysis, your market research, and your financial plan. And then you can start digging into what legal components need to be considered as part of that process. So when you're doing legal planning at the beginning of your business adventure, the first question that I would ask you as a lawyer would be, where's the business located? And that's not just it's at my house or it's in this building or that building, but really where's it located from a what county is it in, what city is it in, what state is it in? Is it virtual or is it physical? Are there elements of that business that are going to require licensing, are going to require things like sales tax collection, are going to require registration with a state, a local government? And depending on where the business is located and whether it's physical or virtual, may also impact elements around the lease or how your investments need to be structured or how the business should be structured, because certain states have certain rules around what types of businesses can be located in certain places. You've got zoning restrictions, you've got other restrictions that you need to keep in mind. So the first question I'm going to ask is, where's your business located? Almost before I ask what is your business, because that's going to allow me to put in the right frame of mind. Okay, given where your business is located, now I can start thinking about the set of laws and regulations that are going to impact that business. The next is going to be, what are your sources of capital? And that capital is another way of saying how are you going to fund your startup? So where are you going to get the money to be able to put your business in business? Is it going to come from your personal savings? Is it going to come from outside investors? Is it going to come from bank loans? Is it going to come from friends and family? All those elements are components that need to be planned for as part of your legal planning process. Who are your investors? So if you've got outside investors, passive or active, who are they? Are they private equity firms? Are they Individual angel investors, are they friends and family? Are they your family? Because each one of those may require different planning from the standpoint of corporate governance, from the standpoint of how you think about your capital stack, and what legal entity might be best suited to handle those investors. The next question that needs to be asked is, how exposed are you personally? So depending on the type of business, and I'll use an example, a law firm in the state of Washington must be owned by an attorney, and it's called a professional corporation or a professional liability company, limited liability company, and or a sole proprietor, and the lawyer is going to be personally liable for malpractice and can't use the LLC or a corporation to protect their personal assets. On the other side of the coin, you may have SBA loans which require personal guarantees, and we'll talk about that when we talk about financing. You may have a bunch of assets that you've either inherited or are commingled with a partner or with a spouse that expose you to a bunch of liability from the standpoint of you've got assets that can be seized, but aren't necessarily within your business or used in your business. So how exposed are you personally is going to be, and what assets do you personally own, are going to be things that we need to be thinking about as we kind of move through the startup process, because we want to make sure that those are protected to the extent possible. And then the last piece is, as you're starting to talk about your business to other folks, there's two things that we need to keep in mind. The first one is, do you have a non-disclosure agreement put together? And attorneys generally have these readily available that they can get to you. You may find some online, but I would caution you to make sure that they suit your jurisdiction and use case. But as you're talking to potential vendors, potential customers, potential investors, you want to make sure that you've got a non-disclosure agreement in place so that way they can't share your confidential information with other folks or utilize that information to their own business advantage outside of any contemplated transactions that you've got with that particular individual or business. And the last one is, does Reg D apply? And Reg D is essentially a law that, and we'll talk more about securities and fundraising, but it's essentially a law which says you can't just go out and offer shares of your company to anybody. You have to go through a process by which, if you're going to offer investment in your business, it either needs to be to qualified investors, and there's a definition for a qualified investor, or it needs to be somebody who you know very well and personally, who's going to be able to invest in that business. You can't just go, hey, I'm starting a new business, put up a website and say, if you want to invest in my business, apply here. That's a Reg D violation. And so does Reg D apply? When you're looking at how do you intend to raise your capital, that second bullet point, does Reg D apply? Because if it does, you've got additional filings and requirements that you're going to need to fulfill in order to be able to raise that money. So a few things to consider when we talk about fundraising is, how did you fund the business? And each one of these has pros and cons, and I'm going to talk a little bit about each one of the pros and cons as we go through, because it's something you need to be thinking about when you make the decision to fund the business. If you're going to use your own cash savings, that cash savings can go into the business either as equity or as a loan from your family or from your personal self to a business entity. And each one of those has tax implications. And if you utilize it as a loan, you're going to want to make sure that that is well documented, so that way you've got the ability to pay yourself back over time from a tax perspective to an advantage situation, but also be able to potentially, in the event the business goes bad, be able to consider yourself a creditor as opposed to an equity holder. And again, creditors are higher in priority when businesses go bad and getting repaid. Equity holders are always at the bottom of the list. You're going to need to be able to consider whether you had enough equity, because courts are going to look at that and go, did you have enough equity in the business? Do you have enough at risk? And how much of that should be a loan and how much of that should be equity? That's going to come from a cash savings. Those are things that you need to consider. generally. So are you going to fund it with cash savings? And if so, are there tax implications to cash savings? Cash value life insurance. This has become less and less common, but a number of people have cash value life insurance where you could borrow the money from your life insurance policy and invest it in your business, or you can cash out your life insurance policy. It may be important that you retain that life insurance policy for things like buyout provisions in the event that you pass away and your business needs to buy out a partner, or to be able to fund or backstop your SBA loan in the event that you get a loan from a bank. A lot of times they require insurance in order to ensure that the business is paid off, at which time if you die and they have an outstanding loan. And it may be that you're not able to get additional insurance. So you're going to want to be very careful if you're going to utilize insurance for funding the startup of your business, because that insurance policy may be an important part of planning either your exit strategy in the event of your early death, or paying off the loan in the event of your early death. You may want to borrow from your retirement plan. A lot of retirement plans have provisions where you can borrow from them. So 401k, where you can borrow the money. A couple things to consider, however. First one is, if you borrow from your 401k, as soon as you stop being employed at that employer, that loan has to be repaid in full, or you have to pay a penalty and it's deemed to be a distribution. So if you're going to borrow from your retirement plan, it's likely to be a side hustle that you're borrowing for, because otherwise you're going to end up, your business takes off and you borrow from your retirement plan and you get your business started and you go, hey, I got $100,000 in my 401k, I'm going to be able to get this thing going. And then all of a sudden you quit your job, that retirement plan needs to be paid back in full in a very short period of time. And so otherwise it's deemed to be a distribution. So you want to be very careful about how you funded if you used borrowing from your retirement plan as a funding mechanism. Home equity. So you have a house, there's equity in the house. You may use a home equity line of credit to access that. Again, if you're getting a SBA loan, which is the last one on the list, they're going to attach to everything. So the home equity, you're going to want to make sure you get the cash out ahead of applying for your SBA loan. And again, that puts your house at risk, depending on the state in which you live. Some states have homestead exemptions, which will protect your home. But in general, home equity puts your home at risk. So you've got to be think carefully before you use home equity as a startup funds. It's generally a very advantaged element, or a very advantaged low-cost way of accessing capital that's otherwise sitting idle, but it does put your home at risk. The other thing is, if you're going to draw home equity, you're going to want to trace those funds, so put them into a separate account, the business account, immediately, and make sure you follow that money out, because business interest is deductible. Home equity interest is no longer deductible after the last tax act. And so as a result, you're going to want to trace that money. You're going to want to make sure that you show the IRS in the event of an audit that it's been kept separate and that it's been utilized only for business use. And so if you're going to use home equity, you're going to want to make sure you keep that separate. Same thing with credit cards. A lot of people, I started my business on my credit card. Credit card's an extremely high rate of interest. It's generally easy to get. If you end up going upside down or bankrupt, you can generally discharge that debt. But you're also going to want to trace the use of those credit cards. So have credit cards specifically for business use only, because that's going to make it easier for you to be able to one, say that that credit card was solely used for business from the standpoint of having to utilize or write off the interest, but also in the event that the business goes bad and you have to put a filing on your credit report, you're going to be able to show that, hey, this credit card was for business use only. If you can get a corporate card, that's going to be a better answer than even utilizing a credit card in your own name. Friends and family loans are a very common way to get businesses started. You go to your friends, you go to your family, and go, hey, could you loan me a couple $1,000? I'm starting a new restaurant, etc. Remember two things about friends and family loans. One, they need to be documented just as if it was a bank loan. So in order to be able to preserve the write-off for you on the interest, and they will have to report the income, you're going to have to document that loan the same way you would a bank loan. And the other piece is, they need to understand, and you need to understand, that if that loan goes bad, they're either going to come after you or they're never going to get paid back, or both. And so again, friends and family loans have It's generally going to be one of the easier ways to raise money, but you may put those relationships at risk, and it does require the same level of legal documentation as any other loan would in order to make sure that it's not treated as equity or that it's not a violation of Reg D. You've got bank loans and SBA loans, and the two of those have a distinction with a difference. Both bank loans and SBA loans are granted by banks and other financial institutions to small businesses in order to be able to get themselves started or to acquire a new business. The difference is SBA loans are guaranteed by the federal government up to 90% of the loan value, so that there's an incentive for banks to lend money to new or higher risk businesses. So generally a bank will lend to you a bank loan if you're lower risk, and SBA would tend to be higher risk, and there's funding fees and requirements associated with it. The thing to remember on both of these is banks will give you money when you don't need it and tend not to give you money when you do. So if your business is in trouble or just getting started, bank loans in particular tend to be very difficult to get. The SBA, on the other hand, may be able to give you some loans, and they've got a number of loan programs, but they are also going to attach every asset that you own. So if you own a home, they're going to put a mortgage, they're going to put a deed of trust or other encumbrance on that house. If you have securities, they're going to encumber the securities. If you have bank accounts, they're going to encumber the bank accounts. They're essentially going to take all of your assets as security for the loan in addition to the business assets. And they go through the business assets first, and then they come looking for the personal assets. In both cases, bank loans and SBA loans, you're generally going to sign what's called a personal guarantee. A personal guarantee is essentially a promise from you that if the business goes bad, even if it's an LLC or a corporation or other limited liability entity, which we'll talk about here shortly, that you will use your personal money to pay back that loan. So in order to provide them an incentive, an inducement to give you the loan, they then will go, okay, fine, we'll give your business a loan, so we'll loan the money to ABC LLC. But you're going to need to personally guarantee that loan as well, which means if the business goes bad and can't repay, you have to repay. And they may get a judgment on you and attach that judgment to your real property. They may attach that judgment to, they may get a wage garnishment on your new job. So again, just be prepared for personal guarantees. We'll talk a little bit more about that toward the end of the course when we talk about winding down your business. But personal guarantees are something to keep in mind. The other thing that I'll just toss in here is sometimes vendors will ask you to sign a personal guarantee as well. To the extent possible, try not to do that, particularly at the startup point. If you have an absolutely critical vendor that you need to sign a personal guarantee to, try and limit it to a specific dollar amount, like $1,000, or it's a bottom guarantee where essentially they have to wait for the entire business liquidation process to proceed before they can attach you or sue you as the guarantor. But in general, I've recommended to my clients that, hey, if you've got a vendor that's requiring a personal guarantee, unless they're absolutely critical and you can't find another vendor, go find another vendor. Or tell them, I'm not going to do business with you. I'm going to go find another vendor unless you can remove that personal guarantee. 90% of the time, they're going to be willing to do that.